Good evening, everyone, and welcome. I see we have just hit 5 o'clock, so we're going to make a slow start. Welcome once again. My name is Peter Menon. I am the Director for Legal for Trafalgar, as well as the Branch Manager for Johannesburg, working out of the Birdhaven office. I will be opening for Andrew Schaefer this evening. Unfortunately, he couldn't join us. He's going to certainly be missed. We are going to be talking about understanding financial statements without being accountant. Now, I'll be honest with you up front. The person Trafalgar has put in front of you to open a session on financial statements is an attorney. So if you're a trustee or a director who feels a small wave of dread when the annual financial statements land in your inbox, believe me, you're in very good company. We're all going to get an explanation this evening. I make my living reading contracts, not cash flow statements. And I still remember the first body corporate balance sheet that I was handed, that I needed to take the earliest exit. Now, after a while in this position, obviously getting a little bit more comfortable with it. But at the end of the day, this is a session, as we said, understanding financial statements without being an accountant. So I'm going to listen intently as well. So that is why I am comfortable and uncomfortable opening tonight for you, because the whole premise of this is at the end of the day is you don't need to be an accountant to understand these numbers. And you also obviously don't need to ask the right questions. So we're going to ask that you keep your questions in the Q&A for us, please. You will not be able to unmute yourself. If you put up your hand, we can't unmute you as well. The chat has also been disabled, but we really have a wonderful session for you this evening with Paul and Ernst, who I'm going to introduce in a moment in time. We're also going to wrap up within an hour. But we are going to try and keep as much time as possible for some Q&A right at the end. So keep those questions flowing. Corinne, Samuel, and Harry, who I'm going to introduce now as well, is going to keep abreast of everything that's happening on the Q&A. And if there's anything that I need to ask Paul and Ernst at the end, we will do so as well. These slides, as well as the recording, will be circulated to everyone who registered, so you don't need to ask for it. Corinne is going to send that through to you after the session. And also, if you've missed any of the previous webinars, all of these are uploaded onto our YouTube channel. So you can go onto YouTube, just type in Trafalgar Property Management, and immediately you're going to get a repository of all the previous webinars, Corinne and I, and even before our time, that has been hosted on the channel. So go and have a look out for that. So how the evening's going to run is we are going to focus on why the statements matter and what they're actually telling you. And then after that, Harry is going to do a short presentation on Trafalgar's AI system and agent. Very interesting and innovative what we've done, only available to Trafalgar clients, but we'll give a further introduction a little bit later on. To introduce our speakers and panelists this evening, Paul Kruger is a chartered accountant, I just want to say Paul Kruger, and registered auditor with more than 2 decades of experience in accounting, auditing, and financial reporting. He established his own practice in 2002, initially providing accounting, auditing, and related services to small and medium-sized enterprises, SMEs. In 2007, Paul chose to specialize exclusively in the auditing of community schemes, including sectional titles and homeowners associations. To support this specialized field, he developed and implemented a dedicated audit software system that streamlines the audit process and enhances both efficiency and audit quality. Paul is passionate about helping trustees, directors, and managing agents better understand financial statements and governance requirements. Through this practical, straightforward approach, he aims to equip community scheme leaders with the confidence to make informed decisions. Welcome, Paul, and thank you very much for joining us this evening. Ernst Botha is a an audit manager at KSI Registered Auditors, working with Paul, and is currently completing his qualification as a registered auditor. Before joining KSI, Ernst gained valuable experience in Big Four audit as a financial manager in industry, giving him practical insight into financial reporting from both the auditors and preparers' perspectives. He also lectured postgraduate taxation at the University of Johannesburg, where he developed a passion for simplifying complex technical concepts. Ernst believes financial statements should be understandable to everybody. I agree with that, and enjoys translating technical accounting principles into practical insights that trustees can confidently apply in their roles. Both are with Krieger Stoltz Incorporated. Welcome, Ernst, and thank you very much for joining us. Also on the panel this evening, just a quick mention, not full bios, Samuel Nicholson, our National Accounting Manager, as well as our stalwart, indefatigable Karim Kutsia, our National Community Scheme Manager, both here to field your questions. And Corinne obviously needs no introduction. She's here every month. Later, Harry Balfour, our sectional title, Take on Accountants from Pretoria, is going to talk to the specialized AI platform that we have created directly through the site for Trafalgar clients. Thank you very much, gentlemen. Thank you, lady. Paul, would you take it away for us, please?
Absolutely. Thank you. Appreciate. Evening, Paul, my name. Ernst will be co-presenting with me. I'll do the initial topics, and then Ernst will drill down into some detail. And thank you to Trafalgar for the invite and allowing us to present this evening. So where to start? According to me, most trustees aren't accountants, and that's the way it should be. You've been elected trustees because the owners in the complex trust your judgment, not because you know accounting standards. But as trustees, you're responsible in making financial decisions on behalf of the owners and the scheme. And that's where it gets difficult. My goal this evening is not to teach you accounting. Our goal this evening is to help you understand financial statements, what they're telling you, what your auditor actually does, and how to ask the right questions. We're going to focus on the financials of body corporates. Although they're very similar to homeowners associations, I'm going to specifically focus on body corporates because they make up the bulk of the community schemes. But the same principles would apply to an HOA and other community schemes. One second, just want to get the right slide. Good. So why do financial statements exist? And I think the easiest way to look at it is, if you're a trustee in a community scheme, you need to know whether the body corporate has enough money. Are the owners paying their levies? Can the body corporate afford future maintenance? And is the body corporate better off financially than it was last year? Now, the place to look for all these answers are in the financial statements. They'll be able to guide you because they tell the story on all of those elements. You can almost think of the financial statements as the body corporate's annual financial report card. They don't tell everything, but on those topics, they'll guide you. So why the three elements of the financial statements are basically the statement of financial position, or as we still refer to it by its old name, the balance sheet. And that tells you where you stand as at the reporting date, at your year end. What were your assets? What were your liabilities? How much cash did you have? The second element, and Ernst will drill into detail later. I just want to give you an overview. The second element is the statement of profit and loss, or called the income statement by its old name. And there it tells you how much levies were billed that year. How much did you spend? What were your expenses? Did you make a surplus or a deficit? And all of that you can see in the income statement. And then the third element is the cash flow statement. A long time ago, I read a little quote that says, turnover is vanity, profit is sanity, and cash flow is reality. And for me, it always boils down to, if you're a trustee, the cash flow. A body corporate can, or a community scheme can make a surplus, but still struggle to pay its creditors if the owners aren't paying their levies. So if your receivables are too high, you can't service your payables. And the cash flow statement helps you understand where the money came from and where it was spent. So sometimes I think people confuse an audit report with financial statements. So maybe if I can clarify first what an audit is and what it does. People think an audit is there to detect fraud. It's not. Although the auditor does consider the risk of fraud during the audit, that's not the primary purpose of an audit. The purpose of an audit is to give an independent opinion whether or not you can rely on the financial statements. So it tells you if the financial statements fairly present the financial position of the body corporate for that year. So it's simply an independent verification on the financial statements. It is not the financial statements. It's just a report on it, okay? Why do body corporates differ from SMEs or trading entities? So unlike many businesses, body corporates don't have a choice. They have to be audited. The Sectional Title Schemes Management Act requires of them to be audited, the financial statements. When the STSMA, the Sectional Title Schemes Management Act, came into operation in October 2016, it introduced additional financial management requirements for body corporates. It also introduced additional reporting responsibilities for auditors. So that means when you do the audit of a body corporate, you don't do just the audit to determine whether the financial statements are accurate or not. You also have to report on additional requirements as set out by the STSMA. So the STSMA, in addition to requiring body corporates' financials to be audited, the auditor also has to report on whether the accounting records were kept separately for the admin fund and the reserve fund, whether the reserve fund money was in a separate bank account, whether they adhered to the minimum requirements for the reserve fund contribution, whether they did a 10-year plan, whether there was a budget approved, whether the AGM was held within 4 months or not. And all of that has to be addressed in the audit report, in addition to the normal audit requirement on giving an opinion on the financial statements. Interestingly enough, SAICA, the South African Institute for Chartered Accountants, and CSOS, the Community Scheme Ombud Service, acknowledged that there was an issue on these additional requirements, and they issued a guide a couple of years ago, and it's available on SAICA's website. if you're interested in that. And in it, it sets out what has to be reported on and then what falls outside the scope of a normal audit. Then what does a clean audit report mean? So a clean audit report means the audit report is unqualified. So the auditor says or tells the user that the financial statements fairly present the financial position of the body corporate. But it doesn't say that it's in good health. It just says you can rely on the financials. So a body corporate can have a clean audit report or an unqualified audit report and still have significant levy debtors, insufficient cash, inadequate reserves, and they might not even have sufficient cash for future maintenance, but the financial statements are accurate and therefore they'll have a clean audit report. Good. And then if I were a trustee, years ago, I had an elderly gentleman phone me. He's a trustee, and he said the bank charges differed by R3 from the last monthly report. And I felt as if the guy was focusing on the wrong stuff. You know, if I were a trustee and I get the financial statements, I wouldn't focus on the bank charges. I would focus on 5 areas. I would want to know, is there enough cash to meet day-to-day obligations? I would be very interested in levy arrears. Did it go up? Did it go down? Are you collecting enough money to pay your creditors and run the complex? Do you have adequate reserves? And that, of course, ties in with your 10-year maintenance plan. Are you spending money? So your expenses, is it in line with the approved budget at the last AGM? Because there you were given guidance as to what you're allowed to do and not. But are you spending the money as approved? And then lastly, if there were any concerns raised by the auditor, and that would all come out in the audit report. I'm going to hand over to Ernst, and he'll then guide you through the financial statements. Thank you for your time.
Great. Okay, so I'm just quickly going to share my screen as well. And enable the slideshow. So yeah, thank you, Paul. A lot about the audit opinion and what the audit opinion actually means to the trustees. But I think something that they're still asking is, you know, how do I actually read the financial statements and how does it actually make sense to me, regardless of what the auditor said on whether I am actually unqualified or not. So the 3 statements I think the trustees should look at is the income statement, which does, like Paul said, show us the did we actually recover enough to keep this body corporate or shared title scheme going. The balance sheet, which shows us the assets and the liabilities, the debtors. Like Paul said, the risk there is that although the income statement might show a surplus or a deficit, did we actually receive the cash, or are levy debtors not actually paying those levies that are in the income statement? And then obviously Paul briefly touched on it, something that's very important to sectional title schemes is the reserve fund, and it's very specific. And do we actually have enough money set aside for that 10-year maintenance plan? And can we trace that it actually is? I think the core message here and what I'm going to do in the next few minutes is the statements aren't just compliance documents. They evidence if you are actually managing the cash correctly. Is your levy actually sufficient to cover the cost and for all owners to keep this community scheme going? And am I actually planning enough for the long-term maintenance to actually continue with this? So if we look at the SAICA, and they've given us a very nice template of what they expect and the bare minimum what you can expect in a sectional title or body corporate template of financials. We'll obviously start with the income statement. And as you can see, there's 3 broad things that any trustee should identify from here. We have the revenue and the other income, which is looking at our ordinary levies, our reserve levies, all the special levies which are in revenue. Other incomes such as some body corporates might have a rental unit, they might have other sources of income such as interest, which can go into the other income. You obviously then have your operating expenses, which would be your gardening, your security, insurance, those type of normal day-to-day expenses. And then something that a lot of trustees should distinguish from, if you are in a financial position or if you have looked at other financial statements, we always tend to look at what is the profit or loss for the year. But very important in a body corporate, we actually look at a surplus or deficit. And the reason we have that specific naming is because ideally, in an ideal world, a body corporate or a HRA is not there to actually make a profit. We're not going to declare dividends from the body corporate and say, we've made a profit, so now everyone that's paid a levy this year, you can get some of your levies back because we've over recovered or we've under recovered. That's not the intention, and that's why we specifically look at a surplus or deficit. And the purpose of an income statement for a sectional title scheme is then actually, did we actually cover our cost? Was this year properly funded? Did we overfund? Did we underfund? And that's what we primarily should be looking at when we look at the income statement. Obviously, this front page of an income statement doesn't give us much detail. So generally at the end of a financial statement set, you can go to one of the last pages and you'll also find a detailed comprehensive income statement where you can see now the revenue is split up between ordinary levies, maintenance levies, special levies, as well as other income, like I mentioned, which can be your interest, insurance claims, all your recoveries as well from your municipals or security recoveries. And then you can also look at the operating expenses and what was actually spent on expenses, and once again, the surplus. Something very important that I want to highlight to you is, as a trustee, what do you actually look at? So you look at 5 core things. The ordinary levy, you obviously approve at the AGM a ordinary levy for the year. Was this actually billed? Did the accounting team actually bill all the owners the ordinary levies, and what is it according to the budget, what we expected? Again, the same thing with the reserve levy. Was it actually approved according to the contribution that we said it will be in the AGM? But also, does it actually match the funding that is required as per our 10-year maintenance plan? From there, you look at the recoveries. Something that's very important in the recoveries is obviously we recover water and electricity. Some body corporates recover security, some gardening, and we have these different type of levies. But we also have to look at it as a trustee. Are we over recovering? Are we under recovering? That is important because it can either indicate that for a municipal account, for instance, the municipality might be billing incorrectly if there's a large over recovery or a large under recovery. Or the metering company that we're using to do these recoveries with are actually charging it at the wrong rates. They're actually recovering at the wrong rate from the fellow owners, and that might cause some ruptions in the body corporate, because that is not the portion or something that we should be focusing on as the trustees. From there, we obviously look at the operating expenses. Here we look for any unexpected cost, anything that looks once off and overspent. And the key here is to always look at a year-by-year comparison, and that's why we give you 2 years in the financial statements as well. Do you actually do you see your security cost is actually improving or increasing above inflation? Do you see that your insurance is going up significantly? And why did those things happen? Because these are the type of questions fellow owners would also ask, just like managing your own portfolio. What type of costs and what type of budget do I need to actually maintain? And like I said, if security providers are going up above, it might be time to consider fellow or other providers for those things. And then once again, like I said, we look at a surplus and deficit. Like I said, the surplus and deficit is to look at, are we actually funding correctly? But something that's very important is that this surplus and deficit needs to also be linked back to the balance sheet. And that's the second statement we'll be looking at, because as Paul mentioned earlier, your income statement might have a large surplus. But if the ordinary levies and the operating expenses are not actually paid in cash, those things will be indicated on the balance sheet, and it might tell a completely different story from the surplus or the deficit in the financial statements. Just before I go to the statement of financial position or the balance sheet, If you follow the SICA template and the auditor that you do use uses that as well, you would have to go to the statement of changes in reserves to actually see what was spent in the reserve fund. You'll see in the previous version I shared that the ordinary and the maintenance reserve, everything has been combined into one income statement. At Kruger-Stoltz and some of our other competitors, we do actually use a simplified presentation method, which is also allowed, where you can actually have a separate income statement for the reserve fund as well, and you can show the expenses and the contributions and interest income for the reserve fund as a separate income statement. And a lot of trustees like this because you can then actually see the funding of the two different funds in a body corporate or a sectional title scheme as two separate funding mechanisms, and you can trace it back to the reserve fund bank. So going over to the balance sheet, like Paul mentioned earlier, the balance sheet is the photograph and the point that we're standing at as at year end. So this will show you your assets and liabilities. Obviously, assets include anything that you own or is due to you. This includes debtors and deposits, levy debtors. So like I said, people can be paying you ordinary levies, or we can be billing the ordinary levies, but if it's not actually paid and it doesn't go to cash, it will come sit on the balance sheet as a levy debtor, as a different type of asset. And similarly, if we are not paying our municipal accounts, it will sit under the liabilities, and that is where the disconnect might come between the two statements, and you have to actually consider both of them for the actual cash flow perspective. And then very importantly, on a body corporate or other sectional title scheme like a homeowners association, you might have, for body corporates, always a reserve fund and an administrative surplus. So you'll see under the equities, there'll be a reserve fund as well as an administrative accumulated surplus. On an HOA, you might have both or maybe one. Very important, something that I just want to focus on, and you'll see we've highlighted that the property, plant and equipment is on there. A lot of question that we get, or a question that we get a lot, is that when we have big expenditures such as building a wall or building a guardhouse, the trustees always want to go and say, but where is this guardhouse under our PPE, our property, plant and equipment on the financial statements? And the test is never the size of the payment. It's whether you actually have a recognizable resource which will result in economic benefits in the future. So if we look at a boundary wall or a guardhouse, this usually forms part of the common property that is owned by all the owners. And this is not something that you're going to rent out to receive money. It's not something that you administer or maintain to actually get a bigger economic benefit out of it. It's not something that you're going to sell or lease. And therefore, we say that there's not actually an economic benefit recognized because of this. And it's usually shown as expenditure on the balance sheet rather than being capitalized as an asset with an enduring benefit. A lot of trustees might argue that, now we have added security, raises the property value, those type of things. But once again, that property raised value is part of the common property, and it's realized by the individual owner who then sells their unit for a higher price, and not that of the common property that is being valued higher. So that's why it doesn't get recognized. A municipal deposit is something that can sit on the line. It's something that we get a lot of questions on as well. Usually a municipal deposit or other types of deposits are refundable. And we'd like to see that on our assets as something that can come back to us. It's not just money that we spent. But realistically, what body corporate or sectional title scheme will actually be sold in future as a whole, so that the body corporate as a community gets back that deposit? The answer is more likely than not that you won't ever be selling a body corporate as a whole, because that doesn't make any sense. So there is actually no practical right to recover that deposit, and that's why a lot of times people just take it directly to the income statement. There is obviously some other deposits like Eskom, which earns interest, and then it's better to sometimes show that on the balance sheet, but that is up to the trustees and management decision as to whether they see that economic inflow of resources coming in. A lot of body corporates and homeowners associations also have a unit that is owned by the body corporate. This was ever either part of the development, where the developer actually gave them a unit when they developed, and it's owned actually by the body corporates. And in these instances, you can see that you're obviously going to earn some rental. You're obviously going to rent it out or use capital appreciation and sell it at a later date. And now the requirement is met to say that it's not going to be an expense because we are going to get economic benefits from that, and we actually recognize it on PPE. So that's just a very important distinction that we should be making. And like I showed you guys earlier, on the balance sheet, we can have, on the income statement, we can sometimes have two separate income statements. But something that's very important regarding the balance sheet is there is two funds with two separate stories, but the balance sheet is one legal entity, and we show the balance sheet, the reserve fund activity, and the admin fund activity as one body corporate balance sheet. The practical reconciliation of this, I will explain in the next few slides, but it is so that the reserve fund bank and the reserve fund equity can actually be balanced. So before I go there, I just quickly want to go over the reserve fund and what it is and what it's not. The reserve fund is something that's specific to the body corporates and the sectional title schemes, and it's not spare cash that we are accumulating for the future. Very specific in the STSMA is that we should actually establish and maintain a reserve fund, and we must have a proper 10-year maintenance plan in place. So it is definitely for only those 10-year maintenance, repair, and replacement plan. It is for any major common property repair which is included in those projects in the 10-year maintenance plan. It can also allow the STSMA where urgent maintenance should be done, but it should be falling under a topic that was already in the maintenance plan. It's a very specific proviso of the STSMA and very important that it's distinguished that if there's urgent maintenance to one of the projects that was already in the 10-year maintenance plan, it can technically be funded out of the reserve fund, but generally it's not for routine operating expenses that's already budgeted in your admin fund yearly budget. It's not for masking poor levy collection. So it's not for using the money of the reserve fund or reserve levies and actually using that to fund your administrative expenses. And it's definitely not for your discretion or spending outside of your approved maintenance plan. So the key principle here is that your reserve fund is for the 10-year maintenance plan, and that's why you collect it. And that's why you have to look at the reserve fund and the funding of that separately to make sure that you are actually funding the reserve fund. I'm going to just go through this slide from the bottom upwards because the thing that I just mentioned to say that the reserve fund equity and the reserve fund bank should usually equal each other, and it's a common view that's actually interpreted in practice, is because from the SCSMA, you can see at the bottom, the legal point says that part of the levies designated for the reserve fund and the reserve interest and all of that should be paid over into the reserve fund yearly. So as per the Act, any money that is collected for reserve fund purposes should be paid over to the reserve fund. What does that mean? It should be physically transferred into that bank account. And the best practice for a trustee is when these levies are collected on a monthly basis or the interest is earned, but that would obviously already be in the bank account. You transfer that reserve fund portion into your reserve fund account, and it makes the reconciliation much easier. So obviously, if you do have any expenses or accruals at year end, those should be sitting in the balance sheet as a whole and should be sitting actually technically in the admin fund side of it, because like this legal point says, you should be transferring as you bill the levy, it should be transferred every month into the reserve fund. Therefore, the levy debtor remains on the admin fund side, and it's very important that we distinguish that, and that's where the auditors usually then do a year-end adjustment to make sure that your reserve fund bank, because technically everything should have been transferred into the reserve fund bank, is transferred in that way. So yeah, what should not be happening is that the reserve equity shouldn't grow and the bank shouldn't go down based on the principle that I said now. The reserve money is used to pay shouldn't be used to pay your admin creditors, so your admin expenses. The reserve fund should shouldn't be left until year-end and forgotten, because we see that a lot of times where this money isn't transferred, and then at year-end there isn't money to actually transfer it into the reserve fund, and that causes issues. And the trustees cannot link the reserve spending to approved plan. There must always be a reason why we are spending out of that bank account. So then just lastly from me, something that's very important for the trustees is just the minimum reserve contribution, and it's something we get a lot of questions on. The STSMA gives you an exact way of calculating it to say the reserve fund can either be in one of those brackets of 25%, 25 to 100, or over 100%. The way you compute that is you compare the reserve fund balance at the end of the previous year with the admin fund contribution. So i.e. you take your levies from your admin fund contributions over your reserve fund balance, and you actually check what the percentage is, and based on that you actually fall into one of those percentages, and the Act actually gives you exactly how much you should contribute or plan to contribute in the next year. I'm not going to go through that in detail just because I'm conscious for time, but that is something that is specifically given in the Act and can actually be computed by a trustee as part of the financial benefit. So just bringing it all together, a body corporate's financial statement should show these three things clearly. And it's linking to both what me and Paul said. Was the year properly funded? So that's looking at the income statement. What money is available and what is owed? That's looking at both the cash flow statement and the income and the balance sheet. And is the reserve fund actually allocated and protected for our future maintenance plans and according to the maintenance plan that is in place? So once again, thanks for the opportunity. I think we're going to move over to a Q&A session now.
Adams, thank you very much. We are first going to move over to Harry, who is just going to do a short presentation for us on our AI platform. And then thereafter, we will move into the Q&A. There hasn't been a lot of questions in the Q&A, so please keep those questions coming. We did prepare a couple before the time as well, but please keep those questions coming. Harry, over to you. Thank you.
All right, thank you very much, Peter, and everyone. Welcome. So I will be doing a short presentation of the exclusive AI assistant available with Trafalgar for any of our clients. So we have a standard app dashboard and for all the financial management of a specific client. And included in our services is an AI assistant. Now, this AI assistant was created and designated to assist trustees with the day-to-day financial management of the entity. Now, you've heard a lot of comments and questions from both Paul and Ernest of Aaron's about the entity, what to look at, what type of questions to ask, and how to review the financial statements. Now, these questions are not limited to the financial statements only, but can be reviewed throughout the financial year. So here we have an example of Trafalgar's AI assistant, and if we take one of the simple questions that Paul posed, show us spending versus budget. And now that's all we're going to submit to the AI assistant. And you can see it's looking at the data for the entity. This is a specific entity, and it extracted data and a report. Now you'll see, based on the question I've asked, it reviewed the data, and in this case, actual versus budget or spending versus budget refers to the income statement, which Ernst provided detail on, and it gives you a high-level overview. It shows you what was the total income budgeted. Do we have variances, both the income and expenditure, giving us net income? What is our profit? What is our loss? And what are key observations? Not only does it give you on the administrative fund, it also gives on the maintenance reserve fund, showing the total actual income, the budgeted income variances, along with key observations, confirming major projects. Do we have enough funds and are they within the planned budget? So we can see it specifically says includes a large operating expense of 880,000, which was budgeted for within the 10-year maintenance plan. In addition to providing detail to the question asked, it provides you specific reporting that was referred to while giving you this answer. And by simply clicking on the referred document, it draws you into the actual online reporting available. And then from there, it shows you specific line items of the categories, how it is classified, actuals, budgets, variances with multiple selection options. Not only do you see high-level overview, if you click on a specific line item, it will then go into more detail and will show you. For a specific line item, administrative fund levies, we have an actual for the month of July of 145. We budgeted 145, and we have a rounding variance. The same is then for any other budgeted line items and or non-budgeted line items. For example, legal fees, we can see there is no budget, but we do have income generated in this aspect. And we also know why. There's also a field for specific notes to be added, which is notes that's recurringly added by the specific accountant when doing the monthly reporting. So if there are large variances or issues to report on, it's both added here so you can see it as a live example, because this AI assistant extracts data on a live basis and it's not based on prior reporting, but actuals that is now available. So when I posed the question, I didn't specify for periods, but as you can see, we can refer to a month. We can go to year to date. So that then gives me an even broader view to tell me on everything, the full income statement for the full financial year, from the start up until where we are now, including variances per the budget line items, to showcase, are we operating at a net income or a loss? And in this instance, we can see there's a loss. And then you can look into individual line items of where we are over budget and where we're under budget. And in this case, we can look at maintenance and say, we are over budget. And then it tells you notes, see January and March, and the system is then referring you to the report packs or the income statement for January and March to give you more extensive details on the specific months and the actual expenses. So this was just one question posed. So based on the other questions asked, simple questions can be asked. As you've just seen, I asked spending versus budget. Now we can go even simpler than that. If you simply want to see what is your highest operational expenditure or levies in arrears and action taken in these aspects, because these are important questions as emphasized by Paul several times and Ernest, to see what is happening with the levies in arrears or operational expenditure. We can just quickly pose a question: what is the highest operational expenditure? Ask the AI assistant. So it's now referring to the data for the specific entity. So it's not going on a general basis, it's going on your entity. So if you are a trustee, you can log into this and you ask the question. And you see now it gives you, based on the income statement, it tells you where is your highest expenditure, total percentage of the expenditure, and your specific items for our staff. And we can see these are the typical items that any, sectional title schemes have, and that is insurance, security contracts, and staff costs. You can see it's followed by management fees, etc. So you can see overall where is the cash being utilized and how is the budget being operated. And you can see if we look at this entity, permanent staff is 429,000. That's approximately 22.7% of the total budget for the year. Similar questions can be posed for levies in arrears, areas of concern. So if we say, are the levies in arrears up or down? So the AI assistant is set up in a way to take the keywords that you pose and provide as much information as possible. The more specific you are with the questions you pose, the more detailed analysis the AI assistant will give you, but it is set up to address questions with limited information posed and to provide as much detail as possible. Now you can see it gives us a report it shows us the arrears, the increase, the decreases. With credits, gives us key drivers and looks at individual units, handed over, blacklisted. So you can see the system provides you with detailed notes on everything, all the movement, actions taken, etc. So the final question I will be posing in this regard is another simple one, which was one of the 5 questions seen, is where do we stand today? So the system will then go and see, okay, based on the question I'm asking, it has to refer to multiple levels of reporting. So you'll see it goes and it first says get the financial position, the maintenance fund, the levies in arrears, and the operational status. So if you don't have the area or level of expertise to review at a high level or a drill in, this AI assistant is perfect for that because it tells you your financial position, admin fund, and gives you it operating at year-to-date deficit, and it tells you why. Unplanned maintenance, you have a loss. Year-to-date income, you have a profit, etc., giving you details of everything that you asked in this regard.
Can I jump in there quickly?
Yes,
Just
Karin.
to comment, the beauty of the system as well is that you can ask in any language. So you can ask any questions to the AI assistant in your own language, and it will answer you in your own language. We've tested it on very weird languages, and it works. Thanks, Harry.
Thank you,
Harry,
Karin.
perhaps just to climb in here and just ask some specific questions regarding the AI agent as well. Is it's ring fenced within the specific body corporate, correct? So you can't see anybody else's data.
Yes, so it's client specific. It refers only to what happened within that entity. All the financial data, any data books, and any additional documents uploaded. So if you ask the AI assistant, you want to see the plans, it then extracts it and gives you the plans on the AI assistant. So it also refers to documents.
Thank you. And then obviously this is only available to Trafalgar clients who currently have the web app, both trustees, directors, and owners, correct?
That is 100% correct, yes.
Excellent. Harry, thank you so much. Very, very interesting presentation, and something I do think that a lot of clients are going to make use of.
And just one clear thing for the trustees to take note of. Per the POPIA Act, personal information is protected, so trustees can see information of owners in arrears in a high level or in detail. And if an owner poses the same question, there won't be detail. It will be a high level overview stating the levies in arrears are 600,000. It decreased from 610,000, but there will be no personal information shared for unauthorized parties.
Excellent. Harry, thank you so much. Incredibly interesting. Thank you. Thank you.
Thanks, Peter.
Ernst, Paul, moving into another of your sections, I don't see that we've received a lot of Q&A, but there were interesting questions posed by Wilhelmina and Catherine, which I'm going to go into, which Samuel has already answered, but I do think they're important questions. And then just a couple of general questions for the both of you as well. So Wilhelmina posed the question, can you confirm that accounts are prepared on an accrual basis or cash basis? We had auditors which could not handle prepayments for a big project on their template and then resigned as auditors for that reason. So accrual basis or cash basis.
Yeah, I'll take that one. Yeah, that's very interesting. Like I said, in our thing, we look at the surplus and the deficit, and because some people might not pay, we look at the balance sheet as well, and by implication, that means that we do follow the accrual basis. It's very interesting that there are auditors out there that say they can't handle a prepayment on their template, because generally, in compliance with IFRS and the financial reporting standards that we do use in South Africa, financial statements are generally prepared on the accrual basis.
Excellent, thank you. And then Catherine posed a question as well. When an auditor finds instances of non-compliance, which they warn the managing agent or trustees about, and they discover that the same non-compliance is repeated over the following years, um, does the auditor have a responsibility to report the managing agent, the trustees? I know we mentioned, or you mentioned in your discussion, an audit is not a forensic audit. It's not something necessarily that you're going to report directly to the police or IFRS or whatever association. Could you answer to that, please, for us?
Yeah, not knowing all the detail, Peter, it's difficult. But yes, there are circumstances where the auditor has to report. Whoever asked the question can read up on it. It's called a reportable irregularity. And if it ticks all those boxes, then you have to report. If it doesn't, you don't have to report.
And Paul, what are some of those instances that you need to report on?
Well, so it doesn't list the instances necessarily. It has a criteria. So if there's a financial loss to the body corporate on a management level, then it's reportable. But I don't want to. I don't have the details, so I don't want to comment. My answer is going to stay general.
Okay.
But it's
Happy
a
with
very
general?
very easy tick box exercise.
I think something I just might add on to Paul there is as per the STSMA as well as CSOS guidance on and the SICA's guidance on the audit report as well, there is certain compliances which we need to report on, like Paul said, to say, is the budget there? Is the 10-year maintenance plan in place? Those type of things. Those are generally smaller non-compliances, which we do report on in the audit report. There's a specific section which we have to report that in the audit report on. But those are not the type of things that actually results in, like Paul said, in a reportable irregularity where we have to take it to the police or we have to take it to a legal opinion. Those are the type of things that is more of a corrective measure. So like Paul said, not knowing the full scope of where the question is coming from, it's difficult to just give a straight answer.
Certainly. Catherine, if you've got any direct questions on this, you're more than welcome to email us and we will pose those questions directly to Ernst and Paul as well. Give us some context there. Thank you. Elizabeth has posted, I have a question around legal fees payment. How are these accounted for in the financial statement? Because owners in arrears are charged the legal fee. However, the body corporate pays the lawyers monthly. Ernst, Paul? Whoever would like to take that. Paul, do you want to go for it?
Yeah, that is a good question. So the and it depends if it's body corporate or HOA. The expense is paid for by the body corporate, but as soon as it's taxed, it can be billed to the debtor, and then becomes a recovery. So in theory, whatever the body corporate does expense at some point will be recovered from the owner, the defaulting owner, by billing it to the owner.
Excellent. Thank you, Paul. Then just a couple of generic questions and things that we documented before the time. Ernst, you went through your slide 23, and the fixed minimum amounts of reserve funds. Would you just repeat that for us? What are the fixed minimum amounts? Is there a cash value, or how does that get worked out?
Sorry, just
You're
unmuting
on
myself.
mute.
Yeah, now I need to just open my slides quickly again and go to slide 23. But yeah, so like I said, the STSMA gives you, and Regulation 2 specifically, gives you the sub-minimums to contribute in order to remain compliant with the regulations of this act, and it's specific to the body corporates and the sectional title schemes. So it's a lot of the time people just look at dividing my admin fund contributions by my reserve fund and saying, does this look more or less 15% because they look at the first one, or 25%? And it's not really a fixed number every year or something that you can determine just off the bat. You actually have to go read that section and see, there's a 20, you need to first fall within one of the 3 requirements. So there's a 25% requirement, a 25 to 100% requirement, and an above 100% requirement. And that then gives you, once you fall into one of the brackets, that tells you, so it's kind of a two-way calculation. First, you need to do a percentage calculation to see what is your reserve fund balance versus the levies that you're recovering. You'll get a percentage. Based on that percentage, you get grouped into one of the 3 buckets. And based on those 3 buckets, each bucket then gives you a requirement of what you need to meet. So for instance, the 25 or less % bucket says that your minimum reserve contribution must be at least 15% of your budgeted annual contribution. So if you're in that budget, or in that bracket, you'll look at the admin fund contribution times it by 15% to get the minimum requirement. But that's obviously only if you're in that bracket. So it's basically a twofold calculation.
Excellent. One of the things that always is overlooked is this, and it's so vitally important for all future projects, etc. Okay, we don't have any further comments or questions in the chat. Thank you very much, Corinne.
Sorry, I just wanna, there's one lady that keeps on raising her hand. Rieta du Plessis, she keeps on raising her hand.
Rieta, unfortunately, we can't unmute you. You're going to have to pose your question in the Q&A. We are running a little bit out of time, so we do have our contact details and email addresses up on the screen. If it's any question related to Trafalgar or to audit practices in general and financial statements, please go ahead and email us those questions. We will get back to you as soon as possible. A super big thank you to Ernst and Paul. Thank you so much for joining us. We truly appreciate it. Corinne has put up the survey questions as well in the chat, and it's going to be emailed to you afterwards, together with the slides and the recording. Please remember to send us your questions, whatever you have. But Paul, Ernst, Trafalgar team, appreciate it so much. Thank you very much for joining us. Have a lovely evening further, everybody, and thank you.